When I did my analysis, I had a lot of inner conflict between being bullish and bearish, and that includes how I feel about AMC and GameStop. So what I'm going to do is make this video with the assumption that the Federal Reserve does not cause a market rally. So that's the assumption moving here on forward. Now, if the Fed does decide to rally the markets, that's great. Things are just going to go up. Whatever, who cares? So I'm going to focus my analysis on the bearish potential here. And I understand that people don't like that, but whatever. It's my vlog. Moving into AMC. So I have my default drawings pulled up here. Typically I show this on the daily time scale, but I wanted to do it on the 15 minute. This looks just like another particular point in time, which I will zoom out and show. But what I want to do here is show how these waves, which I once saw as bullish Elliott waves, have now broken into bearish Elliott waves. And that happened when the price crossed and closed below 1177. Today's close was above there, but I still maintain that I am flipping bearish now. Flipping bearish. This symmetrical triangle seems to define a period of consolidation, and there seems to be another triangle in here, an ascending triangle, at the same time. And this kind of creates this corrective wave pattern, I believe, overall, in a measured move down, which is an ABC correction, or corrective waveform, reactionary wave. There's a lot of ways to talk about it, right? Those all generally mean the same thing. So what I'm looking at are for a couple of three-wave moves. The first started here at 16, and it bottomed down here. It retraced back to 14, and now is, I suppose, going to continue to drop to at least 970 and test that prior low. Now, within this three-wave pattern, each wave is broken into three waves. And you can see that here, how this first move down looks just like the bigger pattern I'm looking for. This is the concept of fractaling in Elliott wave analysis. The second leg, I believe, will also feature that three-wave pattern as well. So that's where I'm at. I'm feeling like this is actually looking pretty bearish. I'm going to zoom out onto the daily time frame and discuss what I see there in terms of candlestick patterns. So you can currently see how the high and the low from today and yesterday make this nice zigzag throughout the price. And this could be very bearish, and it makes sense when you look at it in terms of candlestick patterns. We have matching lows here. And this is bearish, right? Bearish continuation, 61% of the time. That's pretty bearish. Bukowski goes on and discusses what this candlestick pattern is and how to trade it, what to look for. He says, look for a black candle with a tall body. I guess that's not too much of a tall body. So I did also consider this, and it could be tweezers. Tweezers are like miniature double bottoms, but they perform more poorly. And that's probably due to their smaller time frame. The larger the pattern is, the bigger the time frame is, the longer the trend is, the more stable and more predictable it becomes. But as soon as you move into these smaller patterns, intraday patterns, it gets really hairy. And that's why I don't do things like look for double bottoms on the intraday and calculate price targets for them, because I just don't find them to be stable and reliable enough in that way. So tweezer bottoms here, we're gonna have a look. The theoretical performance is bullish reversal because it does have that double bottom look to it. And even people in my Discord are like, hey, look, double bottom. And I'm like, I don't really think it's that solid. It's bearish continuation 52% of the time. That's near random. So near random for me is not potentially bullish, it's random. And that's just the way it has to be sometimes. It's not always going to be clear. That's just life. So two candles sharing the same low price in a downward price trend. It's two candles long. This is good. So I believe that's more of what we're looking at. There is also a possibility here that this is a black gapping, a 2-day black gapping. This is something Obi-Wan sent me. Obi-Wan is like my analyst buddy. He and I are on the same page all the time. So let's call this, let's just look up black gap. Yes, there it is. Two black gapping. And that could be between these two or these two. I'm just going to have a quick look. I don't want to spend too much time on AMC because there's a lot I want to discuss. So we have 2 black candles after a gap. This isn't too strong. If today was red, that would definitely be the case. Whatever. Looking at the momentum indicators, and I primarily rely on volume and RSI. Everything else to me is supplemental. I know the MACD is really good. OB1 is definitely showing the value of stochastics to me. Absolutely. But I continue just to stick to these basic indicators because I feel the most safe with them. I'm the most familiar with them. I do need to branch out a little more, that's true. But that would also increase the length of my videos. So here we go. You can see the RSI did push higher today, of course, because the price did close green. And we did close above yesterday's open, and that is bullish. Volume, though, is really low. And what's implied volatility doing? It's dropping. It's indicating a retracement or a correction, which is what my wave pattern agrees with. So implied volatility is agreeing with my waveform analysis, and the RSI still is in bearish territory. Volume remains to be low, which typically does not signal a rally. It usually signals bearish continuation. Now, I said I was going to go back and look at another period of time where I saw a symmetrical triangle and an ascending triangle meet, and that was back here before the big spill started at the end of 2021. So here's that symmetrical triangle in gray and the ascending triangle in purple, and you can see how they kind of overlap, and there's this really awkward peak, like 3 peak formation before the big dump. That was here, here, and there. And there's even like a little spastic high here between those 3 values before the big dive began. And so when I come down to where we currently are, and it's been a long journey since then, I can see 3 peaks. Look at these peaks. There's one there, there's one there, there's one here. Maybe we get one more little peak that comes up into the range of these other 3 before we dive. Because I see a similar symmetrical triangle with an ascending triangle overlapping it. That's not necessarily a Bulkowski thing. This just looks and feels like AMC is getting ready to dump again. And it could. It's important to be open to that. It could. I've always said that. And if it does turn out that this entire formation through here is corrective, it would be perfectly appropriate to be bullish from this point onward until you lose this uptrend. And that's what I've been saying. And now we are on that uptrend. And what we fail to see is enthusiastic volume and buying, setting the price higher, setting new highs. It's not happening. It's not happening. So tomorrow's going to be a big day. Assuming the Fed does not rally the markets and therefore also rally the meme stocks, this is looking bearish to me. And I'm expecting more downside. And if we do get a big dump on Thursday or Friday, that's going to be really good because I like to play those downtrends and options are cheap. Weekly expiries are cheap the day of. So it's low stakes, high wins if you know how to play the game, which I like to think I do. Going over to GME next. Let's just have a look here. This is weird. Isn't this looking weird? This is looking weird. It's not looking like a very bullish thing anymore. In fact, if anything, you might even have a diamond through here, which could be a half staff formation along the big dump down. I would hate to see GameStop continue to dive. I really would. I am holding AMC and GME long in computer shares, book entry shares. So today was a pretty good day. That was a big green day. As you can see, the close seems to line up pretty well with this flag I was drawing. I'm just going to go ahead and clean this up a little bit because it is kind of messy. Basically what I did is I just took these 2 highs and then I took that and made a parallel trend and I just used one of these lows. And I mean, it's hard. It's hard. Did it or did it not make it back into the flag? Regardless, typically when I see the price drop out of a channel or a pattern and then pull back up and touch the underside but fail to break back into, this typically signals a corrective wave, an ABC move, which here would be to go down, and it would make a fantastic double top. So that's what GameStop is fighting. GameStop is fighting a double top potential here. Once the price closes below the low of this candlestick at 115, if it closes below 115, that's going to confirm the double top, and I'm going to set a price target lower. And it won't be that much lower because it's honestly not that tall of a pattern, so it's not that disconcerting. I think overall the thing to be really looking out for is whether or not we're seeing a broadening formation of some sort appearing, and it is an AMC, It is an AMC. There could be yeah, like a ascending broadening wedge here, which would, to me, also signal that this is a corrective phase and a larger downtrend. And that could bode very poorly. I haven't done any Elliott wave analysis on GME, but to me, this looks like a rally that's fading and losing steam. I know it's not fun to be bearish, right? Well, that's if you're long. You don't have to be long. You don't. You're free. You're free to make money on the downside. In fact, that's what the markets do. So why not you? Why not me? Why not just make money and not be committed to a price direction? You don't have to. So I don't. I just do the analysis, and in my sentiment and bias, I do the best to peg it to the analysis. So that's my 2 cents on that, because whenever I go bearish, I lose subscribers and stuff, and it's totally not cool. Okay, let's have a look at the ETFs here. SPY. What did you do after your great price decline? You formed is it a bullish hammer? Nah, it's not a bullish hammer. Volume was still pretty high. You can see that there was a bounce through here, and the close was within the prior day's close. So this there's a candlestick pattern here. There probably is. Geez, I don't know. Is it this one? Is it the 2 black gapping? It's totally this 2 black gapping pattern. Holy cow. Okay, well, that's bearish continuation 68% of the time. That's a lot. So let's read about this now. Let's go to the ID guidelines, make sure we have it. Configuration. Look for a price gap followed by 2 black candles. The second black candle should have a high below the prior candle's high. The second black candle should have a high below the prior candle's high. Well, that's definitely true. So this is looking great. Now he says 2 black gapping candles that appear within a third of the yearly low perform best. Well, that's true, right? Select tall candles for best performance. They aren't tall, but for the best performance, trade the 2 black gapping candles when the primary trend is downward. Well, that's totally what it is, right? Ah, yeah, great. Okay, so maybe that's what we have to look forward to then? Ouch. Yeah, that's bad. And that's what I said when I saw the gaps showing up. I said, ooh, that looks bad. Because it does. It hurts to look at a chart like this because, look at that. It's terrible. It's just going down. And that could be the case for a while. I mean, look at the RSI. It's not even oversold yet. Not even close. So we have a similar pattern here. Bearish continuation. A 68% chance of bearish continuation. Assuming that the Fed doesn't rally the markets, obviously. Just brutal. So those are the 2 ETFs I follow. I'm going to start also adding the 10-year treasury yield here, and this is where it gets interesting. So I'm at 12 minutes, and that's unfortunate because I'd like to spend 12 minutes here. So I'm going to try to do it in 2 or 3. I'm going to start by zooming out into the monthly chart, the maximum. And TD Ameritrade only gave me back to 1997, and that's okay. So the 10-year treasury yield peaked in 1981 at around 16% and has been on a decline ever since. Now, when you see this at $34.83, $34%, it's actually 3.4%. So it's going to be important to remember that the percent here is actually expressed 1 decimal higher. And what we can see is there is a pretty clear broadening pattern here. And I was trying to figure out, okay, a broadening pattern, this to me means that we're probably in a corrective wave, either a 2 or 4. And the data I found only started in the 60s, and that makes sense. So supposing that 0 is the beginning of wave 1 and wave 2 peaked in 1981 at 16, then or wave 1 peaked at 16% in 1981, then wave 2 can come anywhere between that high and 0 and be valid. And 389 here makes sense. And so if that was all one big corrective wave 2, then the 10-year treasury yield could be on the start of a third wave, a very strong bullish wave that would end higher than wave 1 at 16%. Now, when I say this, it sounds like I'm saying that the bond yields are going to go to the moon. And that is possible, but look at the time scale I'm talking at. I'm talking 50 years, 100 years, right? So it like what benefit does it bring me to analyze such a large trend? I think, though, there is value here because we're in the middle of a corrective wave up after that wave 2. And you can see I have this here. So I'm not sure where we are in terms of degrees, if we're in the super cycle or not or whatever. So I just started with the primary and labeled the top primary one here near 17 or 1.7%. That the second primary wave ended somewhere near 1.1%. Is that right? What's this? 0.3%? I got to figure this out. I gotta figure out why this is expressed like this. All I know is when I look up TNX on finance, Yahoo Finance, it's at 3.48, and this thing's at 34. So I'm gonna have to go look at that because I wasn't paying any attention to the bond yields in 2020. To be honest, the equities markets are pretty new to me. So I still have a lot of study and research to go, and this is gonna be a great direction. So follow me as I learn about this stuff. I'll get ahead of that for tomorrow's video. But continuing this Elliott wave, you can see I have wave 3 is up here, primary wave 3 with intermediate wave 5 ending somewhere up here into the future. It's hard to know where. I also have the intermediate ABC 1, 2, 3, 4, and 5 labeled, and it's possible that this 5 wave actually could continue to extend. So zooming in into the weekly chart, you can see this a little better. There is a small dip and a bounce here on the top of this broadening descending wedge. And typically what this means to me is that we're going to see a big push higher. And while I do have intermediate wave 3 ending here with 4 here, this actually could begin the extension of intermediate wave 5. And this could be 1, 2, and we're about to start wave 3, and wave 3 can't be the shortest wave, and wave 5 is typically the longest wave. So that would mean that we're looking for another push higher in bond yields of equal amplitude to this first one. And so if the 5th intermediate wave does extend, I'm looking for yields to peak up at 4.25%. Let's think about where interest rates are. Is the Fed going to raise interest rates faster than they said they would? Is that going to affect the bond yields? How are the markets going to respond to that? Where's the money going to go? Right? And it's hard because there's an inverse, a negative relationship between SPX and the TNX. I'm going to zoom out. I'll show that. So here you have this downtrend since 1981 in TNX. Big downtrend, huge downtrend. And now I'm going to open up SPX. And my Elliott wave analysis on SPX here is going to be very important because, as you can see, that we've been in a big bull market ever since when? Here's 81. 81 was the end of cycle 2. And we began 3. With any luck, this is all actually going to be, these are primary waves extending cycle wave 3, but if not, we're kind of at the top of the market. So bond yields start dropping in the 80s, and what do equities do? They go up and up and up and up. And yeah, we had a few bumps and bruises along the way. Here we had the Y2K conspiracy theory birth, and here we had the birth of the dollar bubble conspiracy. And, if you were to actually take the presidents of the United States and label them along the chart, you'd have Trump at the very tippy top, which I thought was funny. that amused me. It's ironic, right? The mark of the decline at the very tippy top is Trump. I mean, because Trump would want to put his name at the very top of the stock market, right? Anyway, it's just a joke. I didn't vote for Trump. I'm just going to say that on the record. So here we go. If we're at the top of this big market run on equities and the treasury yields just found their bottom and are now rising, and we're seeing the equities markets correct, I'm talking about a multi-decade relationship between bond yields and equities coming into play, where now equities are going to suffer. That this could be the bear market of the century. And I'm serious when I say that. And it's like, Cap, come on, man, really? I'm like, yeah. We have entire consumer society built on the exploitation of labor, right? And we have to continue to produce more goods because our monetary policy is not controlled by the government. fractional reserve banking. So in order to pay back money on interest, there has to be more money than exists. So what happens is debt is issued, and that becomes money. And, well, what about gross domestic product? It's got to go up with that inflation. Yeah. So what happens when the world's resources, for whatever reason, become more scarce? Be it supply chain shortages, be it peak oil, which was kind of a funny theory. I remember that. And obviously there's still more oil to be drilled. But for whatever the reason is, if goods, commodities can cease to flow into the system, then the money supply becomes relatively larger. So I was thinking about that, and it's just incredible because we've got to get to space. We've basically got to get to space, or it's going to be like pain train time. You have people like Elon Musk, right? Billionaires. They have so much money. But individuals do things that collectives don't, can't, or struggle to do because they have more decision-making power. So you get an individual like Elon Musk who suddenly can, send people into space. Who knows what else he's going to decide to do with his money? That could be really beneficial for society. But at the same time, it's also really, really bad for society. There's always this give and take, this relationship it's so polar, and there's always this fluctuation. And I would rather understand the fluctuations, understand when money is being created and destroyed, than be beholden to just there always being more. Because there won't always be more. It's impossible. It's physically impossible for there to always be more unless you are dividing. Infinity exists in division when you're working in the real world, because there will always be a finite supply of anything that's physical. There's only so much matter. I mean, this is all big, huge, philosophical, whatever stuff, but I think that we are going to have to make a switch to a sustainable economy. A sustainable economy. One in which we aren't just totally destroying the planet. Like, come on. And that's going to mean for a while there's going to be capital destruction, right? The old ways go away. Imagine what would happen if we started to really actually seriously limit the amount of plastic being produced, right? Well, oil would be impacted by that. Demand for crude oil would drop, right? And also the cost of goods may go up because the most readily available and efficient way of packaging is gone. And then at the same time, you're going to have the companies that produce those products disappear as well. And so what you're going to get is a big inflationary effect, and it's not even inflation. It's actually an increase in the cost of goods, which is not inflation. So I think that it's very possible that we go through a very rough period, a transition period, where society is undergoing a rapid change, a leap and a bound, hopefully, that is short. Because I would hate to see a bear market last as long as I think that the transition could take. And I'm just going to be ready for it. Maybe this is my calling, so to speak. I was there for 2008, and I saw what happened, and I'm young enough that I was instilled with a lot of values that favor sustainability and inclusivity and equality. And maybe it's time for my generation to take the baton, so to speak, and start moving the world in the right direction. And I hate to say it, but that's going to hurt the system that currently exists. Some things have to die for new things to be born. That's a fact of life. I'm not saying the stock market's going to die, but I would like to see social media crash. I would love for 2022, 2023 to be the social media bubble, just like the .com bubble. Get that under control. Okay. That's enough ranting. This is too long, so if you like the content, please subscribe. This does take a tremendous amount of effort, more than I thought it would. I am monetized now, so I am trying to improve my production quality so that it's worth watching ads for. If you don't like the content, you wouldn't have made it this far, and you're free to leave a comment. The wittier, the better. In fact, the more naysayers or hecklers in the comments, it makes it kind of fun, right? Like someone today talking about I got a comment about someone theoretically investing in an inverse cap ETF, which is so funny. I'm gonna have to put together a video compilation or a playlist of my best videos where I got the best analysis, because I nailed that rundown from $45 on AMC. Nailed it. Absolutely nailed it. And then I nailed that reversal at 970 too. And well, now I'm thinking maybe 970 isn't the bottom, and we're gonna know very soon. And if I can catch the breakout from the corrective phase that leads to a greater decline, I'm just gonna be nailing it just over and over again. So I really am gonna continue to try to focus on my analysis and improve this so that it's worth watching, that it's worth watching me babble for 25 minutes. Okay, I'm out of here. Happy trading.